We're rolling.
Good afternoon from the Shreveport office of Eagle Financial Management Services. I'm sorry, Eagle Financial, a wealth care company,
There you go.
for the latest edition, the March 3rd edition of the Jack and Bill Show. Well, the roller coaster continues, William. And I thought I'm looking over here at your notes. Looks like you want to talk about what to do with cash, perhaps. But I've thought, if we go back to, there was a rally. Of course, the S&P 500 finished down something like in the 18 to 20% range last year. Call it 18 and a half, thereabout. The NASDAQ market closer to 30. Mm-hmm. And the investment grade bond market is measured by the Barclays Aggregate Index down between 13 and 14%. So no place to hide last year except in alternatives, which we have had heavy exposure to. So we had this reprieve. We were down significantly more. And, right when everyone thinks that the sky is falling, things will often turn around. So we had this Goldilocks market where Goldilocks, the view was things are slowing down. The economy's growing. The Fed has got this thing. Okay, so we went from the CPI, Consumer Price Index, inflationary numbers had climbed. This was going since I think like April of 2021. We climbed all the way up to 9 and change, a 9 handle on the CPI, and the PPI, I believe, hit 10.3. So some analysts like to take those two numbers, to add them up, divide them by 2, and you get the finished goods and the wholesale or raw materials goods, a good indicator of how much prices are rising. So we got to about 9.5, and then with Fed policy and the tightenings, and they were horrific by historical standards. We're taking the Fed funds rate up to 4 3/4 from 0 in a very short period of time, starting with March of last year. So now it looks like the CPI, PPI numbers start coming down. This is Goldilocks. Okay. Disinflation we see as the CPI declines to 6.5%. So then October 10, market S&P 500 bottomed at near 3452, and then began a steady climb all the way to the 2nd of February to call it almost 4,200. That's a 22% increase from the lows. And then we find ourselves today, at the end of January, we were up, call it 8%. And through yesterday's close, S&P 500 with reinvested dividends was up about 4%. And all of the gains in the bond market this year being wiped out. So with that, I was thinking of a topic, Bill, that we could call this Goldilocks devoured by the 3 bears. Okay. So here's why. The Goldilocks scenario of everything is just right, is our porridge is not too cold and not too hot, but just right. Our porridge has been way heated up. So we had the January employment numbers came out at 517,000. We're not going to see what that number looks like until because the first March 1st hit, this week. It's only March 3rd today. Ordinarily, the employment numbers would be out today, but they're delayed till the following Friday. That's a very important number for the direction of Fed policy and where the markets are going to go. So we had the $517,000 jobs created in January, retail sales 3% month over month. And then we had the CPI and PPI prints that grossly disappointed, with only disinflation, falling to roughly, call it 0.1%. So now there's all this talk that Goldilocks is dead, potentially being devoured by the bear, or I could say the bear in the bond market, the bear in the stock market. I'm not sure what the third bear would be, but disinflation talk is it over or not? We don't know. Time will tell. But today we get a February retail sales number that counters the huge one we had for January. And so now, I was thinking about Goldilocks being devoured, and today is actually a Goldilocks day. So all this Fed policy is bringing about a slowdown from economic growth. The last 6 months has been almost 3%, which is, that would be, those are very nice, robust numbers in comparison to what we've had since George Bush, Barack Obama, Donald Trump. Those years averaging the most lethargic growth in the 1% to 2% range. So we've got a very strong rally happening today, with the S&P 500 up to 4024, up 1.1%. The NASDAQ market's up more than that. And
well, there was also talk about one of the Fed governors recommending a 25 basis point hike at the next FOMC meeting. But I'll just say this
as an alternative to what?
As an alternative to something much greater. I'll just say this. It's our job to follow economic data like this. As that's what we're paid to do. But we don't want our clients doing that necessarily, because these data points are more meaningful for short-term traders. They're not particularly meaningful for long-term investors.
Oh, and I'd like to throw in there, I had a nervous client call me up and tell me he saw a Morgan Stanley analyst on the television say that stocks are going to fall another 26%. I mean, what are the probabilities that he gets that right?
I mean, it could.
I can find somebody within 10 minutes that's highly respected that says we're going up 25%, sure. And some that are saying we're going down even more. So,
and that's important if you need that money in a short period of time. But most
Correct.
Of our clients are long-term investors. Their money is in tax-deferred retirement accounts. They shouldn't be that concerned about this.
Agree.
Yeah. But I think this is a good segue to, what I wanted the two of us to talk about today. What if you have near-term needs? Well, then you need to be positioned, or have a portion of your assets positioned in liquid, safe investments. And the most liquid, the safest asset is, drum roll, cash. Now, when we talk about liquidity, that's a term that, you hear a lot about liquidity. We're talking about the ability to sell an asset very quickly and easily without taking a hit. And that hit can be taxes, it could be capital losses on the sale, it could be penalties, like if you're taking money from a retirement account or an annuity. So something that's liquid, you can easily get to. And so that would be cash. So think of money you have in the bank, checking account, savings account. Think of cash equivalents, i.e. money market funds, T-bills. Those are things that you want to have to cover near-term expenses. And this term liquidity is sometimes used synonymously with marketability, but they are different. There's an important nuance there. Something can be marketable, like a stock. Publicly traded stock can be marketable, meaning that you can sell it. But if you have to sell it and you're going to take a big loss on that sale, then it's not necessarily liquid. So,
true. Yeah, Bill, I was thinking about this because along these lines, we had all this talk a year ago that 60-40 was dead, and that's a 60% stocks, 40% bonds. Mm-hmm. And what made that really dead was the 40% in bonds paying nothing.
Yep.
And then high valuations with the stock market. Well, from when Goldilocks was thriving, and from October to February here recently, Goldilocks 60-40 came back to being alive and very well. We saw the bond market have a reprieve from getting annihilated, and the stock market bounce about 22%. And this a big part of this, I bought a 1 year U.S. Treasury, a seasoned U.S. Treasury yesterday. I think it had a 2.5% coupon. I bought it at a discount.
Why am I thinking of this? Your seasoned Treasury. Sorry.
That's okay. You can sprinkle it with whatever you want to.
Bad humor.
I was surprised when I looked up the yields a little bit. Bill, I got 5.22% for a client that had a maturing muni bond. And when you look at munis have gotten a little bit pricey, I decided to put the monies into a treasury. But this is earth shattering. This goes with what you're saying. The Fed, if we go back 1 year ago today, the Fed funds rate was still zero.
That's correct.
The Fed was just beginning to tighten. So I didn't look at this, but I'm guessing a 1 year treasury was somewhere around 0.5%. Okay.
Yeah, that's about right.
That number today, it's down a smidgen today. It's probably 5.15 today. But I bought 5.22% yesterday. I mean, if you think of for anyone in our audience that's out there watching saying, this is scary, the markets are making me nervous right now, we can get 5.22% yesterday anyway, thereabouts today, on government guaranteed securities. You don't even have to pay state taxes.
I mean,
on those.
Even a 6-month T-bill is
Same
yielding
thing.
over 5.
Same thing, 6 months over 5, and that is multiples more than what you could get a year ago.
Yeah,
and so
better than a bank CD, because what you just said,
that's
Jack,
right.
That Treasury obligation is state income tax free. And when you buy a CD, you pay state income taxes on your CD, and it may not be as liquid.
Yeah, if you're a Louisiana resident, to put that into perspective, highest marginal tax bracket for Louisiana residents is 6%. So you put your money in the bank and you get 5% on a 1 year CD. Now there's very few banks that are going to do that.
Correct.
If you can get that,
unless it's a teaser.
So let's say you get 5%. It's probably more like 4 3/4. If you multiply that yield by 0.94, that takes you down to 470, and I'm getting 522
right
on a treasury. That's how you compare
that. Treasury is way more liquid than a bank CD, by the way. Way more liquid.
Correct.
Well, we also posted, this was a chart, a graph that JP Morgan Asset Management made, and I thought it was terrific. We posted it on our Facebook page yesterday, showing how to prioritize savings. And the first objective really should be one's emergency savings. That should be your first objective. And that needs to be liquid. Individuals should do that. Businesses should do that. I mean, businesses do that because businesses have near-term liabilities, accounts payable, for example, and so they maintain cash to cover those upcoming liabilities. JP Morgan recommends that for individuals of working age, keep 2 to 3 months of income. If you're a retiree, keep 3 to 6 months of income. And the emphasis has to be on liquidity. Now, in years past, cash was trash. So Fed funds was at zero for a decade, and you just didn't get paid on your cash. Now, you still needed to keep an emergency fund, but you had to accept that you were not going to get paid much of anything for keeping that cash. So there was a disincentive to keep cash. And when there's a disincentive to keep cash, there is an incentive inherent in that to do other things with your cash. And so people were taking money out of the bank and investing it where they were seeing and realizing higher rates of return. That works until it doesn't. Well, right now, we've seen everything flip. So now cash is king, and you can earn 4.5 to 5+% on cash and cash equivalents. And we're seeing a lot of volatility in the stock and bond market. So it's the exact opposite of the environment that we had leading up to this point. I remember in the years ahead of the credit crisis, and I know you remember this too, Jack, when the housing market was on fire. And traditionally, housing prices increase by approximately the rate of inflation. So let's say, 2 to 3% a year. And we were seeing homes increasing at double-digit rates year over year. The housing market was on fire, and people were using their houses as ATM machines. The way they were doing that was that they were borrowing against the house using a home equity line of credit. And if they needed cash, like to pay off credit card bills, for example, they would just pull equity out of their home. Well, that worked until it didn't. And then the housing market burst. And then the long-term asset, the house, declined in value, and they were not able to pull any more money out of the house. So that was not liquid.
We had teaser rates with adjustable rate mortgages, and then we had rates go up. And
that's correct.
Nuke a lot of these people. I mean, there were, you can watch the movie The Big Short, which is a wonderful movie that really articulates what happened with that and the subprime crisis, where actually the whole mortgage-backed investment universe in America, maybe internationally, was founded upon this ideology that real estate prices would not fall
right
in unison, where
because there's only so much land.
Yeah, because real estate is about location. And when you get into a panic type situation, we learn that that's not really the case.
Correct.
And so you had strawberry farmers that made in the movie. There's a Mexican strawberry farmer that made $15,000 a year and lived in a $750,000 house, and a woman, I won't say what her vocation was, but she owned 5 houses. She owned five houses with adjustable rate mortgage.
Well, she cash flowed very well.
Yeah, and she wound up losing everything. So that's an interesting.
Her vocation is not economically sensitive. I'll just leave it at that. But going back to this concept of liquidity, if you were to go to the bank and borrow, not against your house, but just take out a loan, well, the bank wants to look at your assets and liabilities, and they will look at what is liquid. So a house is not considered liquid. yes, you can sell your house, but you can't get that money right away. I mean, just think how long your house may be on the market before it eventually sells. And do you have to mark down the listing price to entice someone to buy it? So, no, that's not liquid. Similarly, if you have retirement accounts, your retirement accounts will probably not be viewed by a banker as liquid. Yes, you may be able to access that money, but you will likely be paying taxes and penalties on that money if you take it out.
I just came up with something.
Yeah, go for it.
The three bears.
No, the third bear. What's
the third bear? Well, the three bears, I was saying, you could look at a bear market as a market, that's declining 20%. So we could say the stock and bond markets, but we dig down into it and think like an economist. We could say that the three bears are inflation, number one. Number two, the Fed's response to it, because it's been ugly and late and not very good. And then thirdly, this is what you're hitting upon: liquidity.
Yeah.
Liquidity, and this is why you say you preface everything you talk about cash investments with how liquid they
Must
are
be liquid.
and the need for liquidity. We do not have liquidity especially in the bond markets. The money center banks, commercial banks, used to make a market in just about everything in huge volume. And though the volume of these securities does not exist today. And we've experienced some of this firsthand, where it took a while for someone to get their money back. And I think that we're going to see these kinds of problems resurface in the future, especially with however far the Fed has to go with this tightening cycle. So keep going.
I mean, that's a great point, because liquidity, I think we take for granted in America. We're very blessed that we have financial markets that are liquid relative to other financial markets around the world.
Oh, we're the gold standard.
We are the gold standard. So if you invest in publicly traded, exchange listed securities, I mean, yes, I mean you can easily transact, provided that the market is healthy. But different types of securities offer different levels of liquidity. Like, for example, so publicly traded versus private investments. So if you buy stock in Apple, that's a very liquid investment, because you can trade on an exchange. There's a lot of trading volume in that stock. Now compare that to you making a private investment in a private company. Well, that's a very illiquid investment. Now, even within the exchange listed publicly traded security universe, there's different liquidity for different securities. So large publicly traded companies have more liquidity than smaller companies. That's a good general rule to go by, because there's less trading volume for stocks of small companies. You also have to look at bid-ask spreads, and that's the spread in price between what a buyer is willing to sell something for and what a seller is willing to sell something for. And for things that are less liquid, that gap can widen. I would also mention bonds. Jack, you pointed it out. Bonds, generally speaking, are not as liquid, because most bonds don't trade on exchanges. They trade what's called over the counter. So willing buyers have to be matched with willing sellers. It's just not as efficient as on an exchange.
Yeah.
Treasuries are different, because treasuries are the most liquid bonds in the world.
Yeah, and by comparison to or how do we quantify that? If you look at a stock like IBM or Amazon or something like that, it's going to have a bid-ask spread, and that's
very narrow.
The difference between the price you sell it at and what you buy it at is going to be a fraction of 0.1%.
Yeah, for
let's
these
say.
large companies.
So, if we're looking that the treasuries markets would be more liquid than that, then we get to like municipal bonds or corporate bonds, and the farther you get away from AAA, we could see even in AAA rated munis, when liquidity dries up, you'll see a bid-ask spread go from say 2 percentage points to 10 percentage points.
Yeah.
And that means that, something you bought at 100 cents on the dollar, it could still be worth 100 cents on the dollar, but but some guy's only willing to give you 90 cents on the dollar.
Yeah.
So if you're desperate, that's what you get.
That's right. And that's a great example of the difference between marketability and liquidity. So, Jack, in your example, you've got a bond, it's priced at 100 at par on your statement, and you try to sell it, and maybe you just get a couple of bids in and they're lowballing you and they want to offer you 90 cents on the dollar. Yeah, it's marketable. You can sell it, but you won't be happy with the price.
Yeah, exactly.
So, and I'll just say one more thing about liquidity. Liquidity is a good gauge of market health. And when the markets are correcting, when there's a lot of fear in the markets, then liquidity can dry up. And so you certainly don't want to have to raise cash in a market that's correcting. So again, keep sufficient emergency funds in cash.
Absolutely. And you're paid to do that.
Yes, you are paid now to do that.
It looks like I'd just like to kind of throw this out as an advertisement, sort of in conclusion. There with all this unrest, with this extreme tightening by Jerome Powell and our Federal Reserve, and the prospects for certainly for more tightenings. I don't think there are a lot more, but we've seen a shift go from being done or nearly done to the futures markets forecasting that the end is somewhere around 5.5 on the Fed funds rate, which would be another 0.75 of a point.
It just depends on the data,
and
whatever comes.
It does. We're about to see another CPI and PPI print for the February numbers, and they're going to be very telling. Is this disinflation over, or are we stuck? And that's going to determine Fed policy. But with that, we're going to deal with the hands that
Yep.
we're dealt with, and here's where the opportunity lies. If you've got any money at all sitting in a bank or a bank CD, you're likely getting or bank money markets, checking accounts, savings accounts, you're likely getting less than 1%. Okay. Maybe 0.5%. We can help you easily get 5 or 6% on short-term bonds right now. So right now we loathe the long-term bond market. We really like the opportunities in cash and short-term bonds, but also, we talked about 60-40 being dead. The prospects for stocks are really not where they've been by historical standards. And Bill, with this potential Goldilocks being dead thing, we're likely seeing a shift back to value.
Oh yeah.
So where we saw the NASDAQ market really make the biggest gains from October to February, I think we're seeing a reversal of that right now. So I would say, with the stock market, we're shifting back to value. If you don't know what that means, if you look at accounting-based metrics like price to earnings, price to book, free cash flow to enterprise value, things like that. The multiple we're looking at, we want high multiples of free cash flow, but the lowest multiples in terms of PE and price to book. So that is something that has worked out especially well. Some of the ones that we own, and you really need to know what you own and know what is the intrinsic value of this thing. And then the other thing is we had a conference call with a hedge fund.
Let me throw this in there before you go into that. Think about what worked well prior to last year's correction. So for the last 10 plus years, it was growth stocks. So we were in a zero bound, low interest rate environment, and it was the growth stocks that excelled in that environment. Well, we're in a different interest rate environment. So the opposite is expected to do well, value.
That's it. And this is a wonderful, wonderful time if you own growth stocks that are up 10% or more this year to rotate into value. If you want any help with any of that or have your portfolio reviewed, let us know. There are also more opportunities in select alternatives that we own because the cash collateral that these things use, I think 1 year Treasury is paying 5.22%. They have a tailwind with what they're doing with their cash. And these are non-correlated asset classes that when put into the context of a diversified portfolio can enhance returns and at the same time reduce risk. So I think, William, I think that's kind of a wrap.
Yeah, that's it. And Wesley said we can't talk about sports. Sorry.
Oh, we'll have sports next week with March Madness beginning. We've got basketball conference championships beginning this weekend. The tournament of 64 will be determined by the end of Sunday night, next week, and we'll have to talk about that one.
Or we'll talk about pickleball.
Okay.
Have a good weekend.